Welcome back to Money Majlis. Today we'll talk about making money. Making money through investing. Specifically, making money through investing in the stock market. And more specifically, making money through investing in the Indian stock market. As you know, India has had a tremendous bull run over the past few years, and the whole world is watching where the Indian stock market goes next. And to help us analyze and understand the Indian stock market better, we have one of the best investing minds from India in our studio today at Money Majlis. Our guest today has featured in India's top investment minds by the Outlook magazine. He was featured by Forbes India as a member of 20 market wizards in 2014. He also happens to be my classmate from the Indian Institute of Management, Calcutta, and a dear friend for 40 years now. But before I reveal my guest today, here is a message from my sponsors.
This podcast is proudly brought to you by MasterCard.
Money Majlis is sponsored by Weo Bank. Fuel your ambitions with banking designed to power your success. Discover more at weo.io.
Money Majlis is brought to you by Network International, the leading digital payments technology company in the Middle East and Africa.
Money Majlis is proudly supported by Aqua Now, the premier crypto-as-a-service provider, now building in partnership with the top financial institutions in the Middle East. Discover more at aquanow.com.
My guest today at Money Majlis is Bharat Shah, who I first met at my business school campus way back in 1984. We joined the Indian Institute of Management together on the same day, me as an engineer with little knowledge of the markets, and Bharat as a chartered accountant and already, I think, an astute investor in the equity markets. Remember, the Bombay Stock Exchange Index, known as the BSE Sensex, was under 1,000 those days. I think around 600. Today it is around 84,000 and expected to hit 100,000 in the next maybe couple of years. I keep thinking that if I had started investing with Bharat way back, 40 years back, I could have grown my money 100 times or more. But in hindsight, as they say, is 2020. Bharat Shah is a director and a partner of the ASK Group, a renowned financial services group based in Mumbai, India, and a leading player in the asset management and wealth management business. ASK has over 20 offices in India and offices now in Dubai and Singapore. ASK is a portfolio company of Blackstone, the world's largest global alternative asset manager. Bharat is a qualified rank-holding chartered accountant, cost accountant, and an MBA topper with 38 years of experience in the Indian capital markets and with a deep interface in the Indian corporate world. He represents comprehensive insights in Indian capital markets with strong emphasis on bottom-up investment. Stock picking is his special strength. As director of ASK Group, he supervises the investment management business of the group. In this role, he provides strategic guidance and support to the CEOs of his portfolio companies. Bharat is deeply passionate about investing in all things that go with it. In 2013, he authored a book titled Of Long-Term Value and Wealth Creation from Equity Investing. Bharat has written several articles on investment in top Indian business magazines and has been a speaker at several international forums on the India opportunity. He has featured in the investment series Wizards of the Lal Street and Classroom. He has also been featured in the book India's Money Monarchs with a chapter dedicated to him. Bharat the Wizard, welcome to Money Majlis. It's my pleasure to host a friend and a classmate, and a privilege to host such an iconic figure from the world of investing in India. How are you doing?
All well. Suvo is a friend, so please discount many encomiums that he has showered upon. And I would urge you to take it with a fair bit of pinch of salt, many of the praise that he has showered. But thank you, Suvo.
Bharat, welcome back to Dubai, which I believe you visit 2 or 3 times a year, and a city you like, and you keep saying that it keeps changing every time you come here. So good to have you back, Bharat.
Thank you.
Let me start with the markets. We are in early 2025 now, and the Indian equity market has been having a secular bull run for the last few years. The Nifty 50 index has tripled since 2020, and the market cap has recently crossed US dollar 5.5 trillion, up from $3 trillion in 2021. This is fueled by continued strong GDP growth and multiple other factors. The current price earnings ratio, or P ratio, for the Indian markets is around 27, the highest across global markets, higher than the US at 26, and significantly higher than Germany at 15, Japan at 13, and China at 10. Bharat, aren't the Indian markets overvalued, and should we brace for a correction?
Well, let me answer that question in multiple parts. Price earning multiple is not an adequate descriptor of underlying value. Mm-hmm. It is used often because it is the most convenient and simple to understand, and therefore unfortunately overused. Mm-hmm. Price earning or value of a business is not just a number but a context. And where does that context come from? From multiple factors. Some of them may appear qualitative, many others are quantitative and qualitative, the mix of both. The first very important indicator of the value creation and the valuation per se is the growth rate. Ultimately, businesses have to grow. If they stop growing, they don't create value. Even in nature, nothing remains where it is. Things have to move forward. If they don't, then at some stage they regress and then they decline after diminuting. Therefore, growth is a very vital engine. There's no getting away from that. And therefore, as an aside, I would say these debates about growth and value, so common in investing discussions, is somewhat artificial, somewhat stilted, Second very important aspect, apart from the growth rate and its, prevalence, is what makes growth embedded, pervasive, and kind of over-encompassing. I would say principally 3 things.
Okay.
One is the durability of growth. That's simple to understand. Other things being equal, business which will have growth for a longer period of time will have a more value than the other business. Second, growth which is more predictable.
Okay.
Now, 2 businesses may start the journey at identical point of time. They achieve the same identical outcome after a given adequate period of time, which means they have exactly identical conditions from beginning till measurement point of termination. And yet a business which is more predictable of the 2 would have a better value than the first business. That is simply because investing is largely about future. Future means uncertainty. When uncertainty is higher, you discount the future with a higher amount of skepticism. When the future has greater degree of veracity in your eyes, then obviously it is less need to be discounted, and therefore it is a superior value. Therefore, predictability has immense value in the value creation. And predictability compared to an accidental chance or a happenstance are not the same thing. One thing is for something to have happened. Other thing is that you predict that it will happen. It is always the latter which will have more value in eyes of the market.
Correct.
The third factor is the resilience. Businesses can never be free from challenges. Things are always dynamic. We are living in a world where things change all the time. Businesses which have deep character, fundamental inner core character to be able to ward off challenges and yet come up trumps. You can't wish away troubles and challenges, but how you deal with them. The good businesses have greater resilience to deal with the challenges. It is these three which make together growth pervasive and deeper value creating. The durability, predictability and resilience. The third very important aspect which makes fundamental value creation principle is the quality of the growth. Return on capital employed, return on equity, all of these have a very powerful impact on the value creation engine. America for decades has been topping the charts in capital efficiency, and therefore for decades American markets have been among the biggest value creators. Incidentally, for the first time last year, Indian ROC and ROE are now exceeding that of America. And this, I would say, is not something which is a minor thing which has happened. I think it's a huge thing which has happened.
Yep.
Therefore, it is not the mathematical number of price earning multiple which is arrived at simply dividing price today with some earning estimate of tomorrow or day after and comparing those numbers and arriving at that valuation. It is a deeper context, and you have to take into account all of these contexts to determine the valuation. Finally, it is not even profits, it is the cash flows. And I think with the capital efficiency improving and rising, profits are converting at a better rate into the cash flows. And that is another reason why the valuations are what they are. One final point I'll put. If you plot a chart of China and India for last 30 years and put a P chart for the two countries, time axis and the price earning multiple of the indices. And throughout the 30-year period, which has been symbolized by stupendous economic growth of China at some 13.5% nominal GDP growth rate, unprecedented. India far more modest, 8.5% nominal GDP dollar growth rate in the same period. Price earning multiple of the two PE charts for 30 years. Throughout the period, you will find India above China. If low P was an indicator of greater returns going ahead, then it would have implied that China would have generated far superior returns in the markets through that curve of 30 years. But the irony is 13.5% GDP the dollar growth for China has produced less than 1% returns in the Chinese markets.
Really?
And 8.5% dollar GDP growth rate for India has produced 8.5% dollar returns in Indian markets. America is, of course, at a different stance. Less than 4% GDP growth rate in that 30-year period, but about little over 9% return. So 5% premium per annum compounded for America, zero premium for India, but thankfully no discount, and some 12% discount on China. None of this is an accident. Therefore, it is not only earnings growth, but the character of that growth, which is a deep implication. And markets are not deceived by these mathematical numbers. Otherwise, and there are scores of markets with single-digit price earning multiples. I would say when you put all of these contexts, India is decently valued. Certainly, prices in 21, 22, 23 are cheaper than what they have been in 24. And therefore, obviously, you had better return earning potential if you had to buy or you were to buy in 21, 22, 23 compared to say 24 or in 25. But that be what it is. You really judge not by valuation as an absolute number, but you convert it into an outcome as to at this price, what are the implied returns that you can hope to get when you forecast the future in terms of growth rate, durability, character of that growth rate, etc. On that count, I am perfectly satisfied that Indian markets are decently valued. They are not overvalued. Certainly they are not cheaply valued, but they are in a healthy shape. And healthy condition is all that you need as an investor. You don't need some generously favorable condition to make decent, healthy outcomes. So I'm fully satisfied with the way markets are. Okay. And I think these markets are going to be 6-digit at some stage. It will be much higher 6-digit at some other stage in future. And it will be further and onward. The journey, in my opinion, has begun, just begun.
Okay. It's a fact, Bharat, that India today represents possibly one of the best markets to invest in. You said elsewhere, the reasons for these are three things: the high rate of growth, real GDP, the durability of growth, we talked about just now, and the quality of the growth. India is also one of the best returns on capital, right? 14%, around that. This compares, I guess, very favorably with the likes of US, China, and Europe. My question to you, Bharat, is how much of India exposure should an international investor plan to take? If I'm dividing my money into different markets globally, what exposure should I take in India?
For that, I'm no expert on international markets. I have only professional interest and kind of observation about markets outside India. But whatever I understand, whatever little I've comprehended, well, you look at Japan, for example. It has taken some 34, 35 years before Japanese markets are back to where they were in late 80s. So it is a long grind that they've suffered. South Korea has still not recovered what the peak they touched 35 years back. Scores of European markets are tottering in negative returns even after a decade. And China, I just mentioned to you, over a 30-year period, Chinese markets have made just about percentage of return. Before these, new set of incentives Chinese announce, and therefore markets have gone up in sympathy. But in my opinion, structural problems can't be resolved by tactical maneuvering. So that's a separate issue. So many of these markets have deep structural issues. Even America, you strip off the magnificent 7, 8 NVIDIAs of the world and Metas and Googles of the world. Rest of the Dow Jones is not particularly flattered in terms of distinguishing by returns over a 10-year period. I think in many respects, India is truly variegated, diverse market. The kind of choices across so many sectors and so many business opportunities of all size and very entrepreneurial country, and therefore a lot of important opportunities entrepreneurs create, because that's the job of entrepreneurs, to assume risk and to think about future and take that bright new opportunity and take risk meaningfully behind it. That variety of the market itself is a significant risk reduction that has happened in Indian market. And any risk reduction is, it corresponds with the improved valuation of the market. Other source of risk reduction in India which has happened is the participation of the local money. Not just institutional, whether pension, whether mutual fund, whether insurance, but also the high net worth, family office, individuals, retail. That participation is very important because you need a counterpoint to global money. And global money many a times moves in a herd and doesn't always reflect very deeply thought out view about a local market.
Yeah.
So many global aspects color their view about their actions in the local market. And foreigners for a long period of time had a disproportionate impact on the destiny of the Indian markets. Well above, they were punching always well above their weight in the Indian market.
Easy come and easy go.
Easy
Yeah.
money. The emergence of Indian money is a fantastic development which has occurred to provide that intelligent and thoughtful counterpoint to the foreign money which is spent.
And even there, I believe the penetration is still very low, right?
It is still less than 6% of the household wealth is in equities compared to in America in 30s and in Europe in 20s.
So upside is tremendous, right?
Upside is tremendous in my opinion. Therefore, that again is a significant risk reduction which has occurred. Every risk reduction in any market on long run is rewarded with the improved returns. It's an unseen but real law of the market. Third, if you see, cost of capital has declined. Again, hard-won battle. We work systematically on curtailing fiscal deficit. Therefore, inflation is getting tamed structurally, not technically. And beneficial outcome of that is reduced cost of capital. The reward for reduced cost of capital is improved valuation. And that is one more reason why markets otherwise deserve to be raised higher than what they have been. Finally, I would say balance sheets of Indian lenders as well as borrowers has never been more healthy than they are today. And you need very healthy balance sheets on both the sides to do well. And to for the borrower to undertake new capital expenditure and to build future, for lenders to feel safe and to be able to lend in volumes to the demand. Both of these are in a very healthy, symbiotic kind of a coexistence today. All of these means that a market with a context of sustained superior growth compared to not only its own past, but compared to probably any other country in the world, in a more durable, more predictable, more resilient way, with a superior capital efficiency, with better balance sheet, with a reduced debt equity ratio. Indian debt equity ratio has come down to half in last 5 years. 80% of debt to equity 5 years back, just before COVID, in 2024, by that time it has come down to half. 40% to the net worth. These, when you put together, I think is presaging the future of the market. I made a comparison of 5% premium that American markets have enjoyed per annum, compounded over 30 years. 12% discount that China has suffered, and zero for India, neither premium nor discount, I think is slated for a change. Indian growth rate, without any doubt, will be higher than that 8.5% it is got over 30 years. Indian capital efficiency has improved. Balance sheets have become stronger. Quality, there was no premium India enjoyed. Thankfully, no discount. But I think quality premium will emerge now. Whether it will be same as what America has got today, whether it will be lower, probably it will be lower for some length of time, but it will be a rising crescendo. And therefore, the twin effect of improving growth rate and emergence of the quality premium, which India did not have, in my opinion, means that India will... forecasting is a dangerous thing to do, and I'm fully cognizant of that.
Yeah.
But if I have to stick my neck out, and if I have to put a picture ahead for next 10 or 20 years, I would say India will be actually number one performing market in the world. One last point. In last 30 years, if you take 10 years, 20 years or 30 years, the two top markets in dollar returns has been either India or America. Either number one is America and number two is India, or it is the other way around. But it is invariably between the two. And I definitely believe future of India is much brighter than the past. And therefore, if I have to make one exception to that rule of not trying to forecast unduly deep into the future, I would say it is rise and rise of Indian opportunity. And it will be kind of a number one bulwark country and market in the world in the coming decade, if not decades.
Amazing, amazing. Bharat, let's move to sectors now for a little while. The Indian stock market is seeing a value migration to newer businesses, things like specialized services, premium goods, and discretionary consumption. Will we see growth shift to these segments? What is your sectoral view of the markets?
I earlier talked about Suvo, that one of the features which has been a risk reduction for the market has been diversity of Indian opportunity. It is across the board. And I also made a point that there is no market comparable to India, not even America, in terms of sheer diversity of the choices. And I think that diversity has gone up multifold in last few years. Here is a market where consumption is rising, but it is no longer the consumption of the staple variety that we all have been accustomed to growing up in India of the yore. It is discretionary. It is luxury consumption, it is premium consumption, it is consumption of durables, which is occupying a greater pedestal than the consumption of the staples. Pharmaceuticals. India clearly is the pharmacy of the world, oft mentioned fact. And India accounts for roughly 40-50% of manufactured pharmaceutical consumption of America. I mean, that's a huge number.
Of course.
The number one medicine consuming country in the world by a margin. India accounts for roughly half of it, what it consumes in different form. And India has migrated over a period of time from a copycat violator to more patent compliant but doing ordinary work, to doing incrementally superior work, to becoming marginal innovator, to becoming a full-fledged innovator, and then over to coming up with breakthrough solutions. I think
like in COVID.
So these capability that Indian pharmaceutical has acquired is tremendous. Automobile, similar journey. 30-40 years back, Indian automobile was hard to really put any meaning behind. But today, without any doubt, India is an automobile hub of the world, one of the most powerful hubs of the world, with a full ecosystem of not just the OEMs, but also components. But very importantly, if you say, for example, in two-wheeler ecosystem, India is not just a dominant player in the world by volume or by growth rate, but I would say it is even, or by the cost structure, even by, innovations and technology, India is fast becoming leader in that segment. And I think tomorrow it will be a leader even in brands across the world in two-wheeler. Capital goods, energy transition, energy equipment, energy financing, infrastructure, whether ports, whether airports, whether roads, defense. India is moved, and rightly so, to do more and more critical technologies in manufacturing within country rather than being unchecked importer of the defense armament. That may not appeal to a lot of traditional defense suppliers in the world, but I think it is perfectly the right thing to do from Indian long-term interests. That in turn is creating a host of new technologies, because defense is very technology intensive area, and it spawns its own ecosystem over a period of time with very powerful ramifications.
Yep.
Manufacturing through production link incentive scheme in variously strategically chosen areas with a full value chain rather than in silos and at a scale not merely to meet local need but for global need as well. Along with that, digitization, technology embrace, powerful digital public infrastructure, I think it is creating traditional strengths in software and various services. India is a harem of opportunities, in my opinion. Multiple, variegated and deep.
Bharat, let's move now to the theory of investing. You have maintained that equities are the asset class that drive value creation, while fixed income at best does maintenance. How should investors plan to optimize risk in their portfolio as well as preserve capital, especially in more volatile market environments? What is the ideal mix, you think, for investors between equities, fixed income, and alternatives? And how should this change as we go older?
Before I answer directly that question, and with many shades that you have raised in that, there are unfortunately, off-quoted paradigms in the world of finance. Higher risk is higher return is one such one. And I've never understood any meaning of that. Fundamentally, in my opinion, in equity investing is all about taking only meaningfully low risk in order to get superior return. Ultimately, real returns are gross returns that you see, but risk undertaken to earn those returns which you don't easily see or always see at a point of measurement. And the real returns earned over a period of time is the gross returns which are visible minus the risk which is visible or less visible over a period of time is the only real return that you make. Therefore, even conceptually, higher risk undertaking will mean reduced net returns as an outcome over a period of time. Therefore, high risk can never be a strategy to earn a superior return. It's only by meaningfully eschewing risk that you can hope to optimize and earn better returns. The risk doesn't mean in ducking or putting your neck into the sand. It is not being ostrich. In every economic activity, there is a risk. It is ability to take a meaningful risk, a risk that you understand, and the risk, the consequences of which you can live with, is the kind of a risk which is at a root of value creation. And therefore, if you see fundamentally, people often confuse returns at an asset class level, gross returns, is a substitute for actual returns that they make, which is actually not true. The gross returns have three enemies to deal with for any asset class. Costs which are incurred to earn that return. Inflation, which is a common enemy that all asset classes face. And third is taxation, which may again vary from one asset class to another. After you reduce the burden of these three enemies from the gross return at an asset class level, what is left behind, the net one, is the real proxy for the value creation. But we often substitute the gross return as a comparison point and as a proxy for likely returns that you earn. Say, for example, let's say fixed income may make in India, say 6%, and equity, let's say, will make 12%. But the equation is not 1:2, 6:12. The inflation, let's say, is 4%, and takes out of that 6% return, say for simplicity's sake, it will be higher, but remove 2%, 1/3. That means the real return in fixed income is 0. In equity, on that same 12%, taxation, let's say, on an average on a given amount of gains that you made, say those 12%, not all of them may be realized. Part of it is realized, and on that a mix of long and short put together, say average about 15%. Let's say on an average you realize 20% of those gains. Therefore, say 15% of the 2.4%, 0.4% will be tax incidents. Therefore, say 12% converts into 11% post-tax. 4% inflation. Therefore, you are left with 7%. So equation is 0 versus 7% and not 6 versus 12.
Interesting.
Therefore, without any question, you need to have tremendous risk-taking capability to put too much money into fixed income. I find that is the most dangerous asset class to be into. Also, why it frightens people? Because people get frightened by volatility. It is volatility people substitute as a source of threat or endangerment to the capital or loss of capital or risk on the capital. Now, equity as an asset class, of course, has a greater volatility in fixed income. Fixed income is less, but not zero. But without any question, equity as an asset class is far more sensitive to the changes, spurious, real noise or signal. Equity markets will react and will create noise or signal depending upon where things are. But markets have always been volatile. They were volatile 2 centuries back, last century, last decade, this year, next decade, next century. Volatility is not a threat. Volatility actually is a friend if you learn to tame it. If psychologically you are in a stable mind and you can observe it with distance, that this is the rhythmic character of the market to fluctuate, and at times in an unpleasant way, at times in a very enticing way, and many other times in a very unpleasant way. But when you realize, like an observer, bystander, that that is the character of the market, it no longer bothers you, it no longer worries you. You still have your emotions involved when you are undergoing that process. But ability to tame your emotions, control your behavior, is at a root of that successful investing. And therefore, volatility is not a threat. If you buy a good business, which is adequate size of opportunity, therefore headroom to grow. Without growth, no value creation, meaningful value creation can happen. If you are in a position to judge that that growth is durable and resilient and predictable, and it is backed by superior character of the growth, all of these you can convert into a crunchable mathematics of the value of a business. And if you, in addition, have a discipline to buy that value package at some price, discount to that value, then you've got additional lever of that price value gap or a margin of safety is an additional one-time extra reward. Therefore, growth, its prevalence and quality are annuity kind of enhancers is source of return. But margin of safety is a meaningful cherry on the top of that cake as a one-time additional one. With these, you simply cannot go wrong. If you can understand equities, if you understand businesses, if you're passionate about it, you're disciplined about it, equities, you can never ever go wrong. It has nothing to do with age. It has nothing to do with poor quality shibboleths like high risk is high return and all that goes on. I think, in my opinion, there is no safer asset class than equity. In fact, it requires a lot of courage and guts to be putting meaningful investment into fixed income and all of that. And
that's quite counterintuitive, right, Bharat?
It is counterintuitive, but when you think over it, when you work through it, you realize why. It all requires taming your own emotions, controlling your own behavior, and juxtaposing your behavior with that of the market and observing how to play that game well, keeping your mind in the right place.
So 2 questions, Bharat, supplementary to what you just said. One is, would you advise change if I'm a 30-year-old versus I'm a 60-year-old, or will it be the same? And part two of the question is, if I'm 60 plus and I'm basing my investments, my objective is to earn income, isn't fixed income better than stocks in terms of regular income generation?
No, I would say, and again, that would vary from individual to individual. Each individual has a different tolerance, capability to deal with the fluctuations. If you are a type where market fluctuations itself will scare you and will take you out of an optimal asset allocation, then probably equity has to be reduced part of your asset allocation, because it's your mental framework, and therefore, if something you are forever scared and
Can't sleep well at night, then it's not worth doing
then
it.
it is simply not worth it. So it will depend upon individual and the context of that individual and his mindset. But if you neutralize that and purely in a clinical way you examine the issue, then obviously value creation will happen only out of the equity investing, or by owning or running a business which is a sound and good quality business. There are only two meaningful ways to earn outsized value creation. One is to own a good business, and either you manage or you get it managed. That can be a tremendous source of value creation. Equity investing is a substitute for it. Except that you don't own the business fully, you own it very partially or very small, and you don't run it. You ride as a parasite on somebody else's talent and capability. But fundamental catalysts for value creation are the same. So equity is nothing if it is not business-like. And all good investing has to be business-like in essential character. As I mentioned, once you deduct the three charges that you make against gross returns earned by an asset class, then the picture becomes much more clear. Then the confusion is sorted out. But like I would say, insurance probably is the worst investment, worse than even fixed income investment to make. But if you are in a situation where without insurance your family can be in a ruination and you are the only breadwinner for the family, then I think that argument is irrelevant. You need insurance because you can't be without it. And therefore, even though it may be a worst value creator, but you still need it and you need to have it. Similarly, some part of the fixed income, if it gives you mental peace, and it gives you some kind of assurance to dip into when you need, especially if you are not earning anything. While you are earning, maybe your earnings can take care of your needs and more, and therefore you can afford to save much more into equity. When you are not earning or earning regular income, then mental framework may suggest you to put some money into fixed income. I won't frown upon it. I think it is a reasonable thing to assume that in those situations people might feel comfort. Whether purely from economic efficiency of that decision making, is it right? It is not. But nothing in life is only economic efficiency. Your emotions, your situation, your context, all are important integral elements of that. So those have to be taken into account. But it has nothing to do with the age. Our old man in Nebraska, Omaha, at a ripe young age of over 90, is still fully invested in equity, virtually his entire wealth, and is very happily jumping to his work every day and doing what he has to do. It has nothing to do with age. That much I can tell you.
Bharat, you talked about one wise old man. Talking of one more, you have been influenced, you say, a lot by the legendary Charlie Munger, who you have met a couple of times, I believe. What are some of the principles of investing that you adopted from him?
Charlie Munger represented, I would say, even though he has passed away, I would say represents sparkling intellect and a razor sharp mind. I mean, a mind which is penetrative, deep intellect, and so to say, can't care less about what the world thinks. I think investing is in many ways lonely activity. When you are doing well, it may be very tempting to ascribe it all to yourself, and it may put you into pedestal. But when chips are down, either because markets are down or because for some reason, invariably in any meaningful investing career, there will be periods when seemingly whatever you do doesn't seem to match up to what markets are producing, or you seem to fall behind. It has happened with every single great investor in the world. Independent mind, a mind which is thinking, but at the same time, independent mind doesn't mean arrogant mind which is not willing to adapt and learn from what is happening, is a mind which is very poor mind in investments. So intellect is not a substitute for discipline. Intellect is not a substitute for integrity. Intellect is not a substitute for character. And intellect is not a substitute for wisdom. I think good investing, while it is meaningfully about reasonable intellect, but it is far more about these other things that I mentioned. And I think Charlie in many ways epitomizes some of these he has not stated it in the language in which I am putting it, but I think you look at his lifetime's work and what he has done. It's not as if he was the wealthiest individual of the world. And compared to his far more known partner and the friend all along, Mr. Buffett, his wealth will pale in comparison to that of Mr. Buffett. But I won't regard his success purely based on the wealth that he has made. While of course he was a billionaire and a good billionaire, but insignificant number compared to the many other contemporaries or other business people. But I think the ability to understand nuances of investing and wealth creation process beyond the obvious is something I would say deeply to be learned from that man. Also, investing liberates you. It gives you choices in the life. Good investing enables you to pursue what you love rather than what you have to do. I think Charlie in many ways epitomized that idea. The freedom with the time. That time is your own in the way you want to use it, in the way you want to spend it, and pursuing exactly what you love and passionate about. I think how to combine the joy of life along with doing it well to generate that wealth, but in a right context, is something, again, Charlie symbolizes in a fantastic way.
You said there investing liberates you. In your book, you said investing is both an art and a science. Where does science stop and where does art begin?
It never stops at one point and something else begins. It always is a confluence of both. There are parts about which it is more of a science, and there is a part which is much more of an art. Investing invariably is both yin and yang of life. What applies in life applies to investing. There are ups and there are downs. It is forever meandering river of life. Therefore, you have confidence about what you have, but at the same time you need to have diffidence so that you don't get carried away. You may have faith, but you must have skepticism. You must have belief, but you must have adequate amount of doubt. All of these intertwined elements of investing really makes investing what it is. The science part is relatively simpler to explain. in terms of comprehending business, what are the mechanics of value creation in a business, what are some of the key levers, some of them I narrated while discussing so far.
Yep.
All of that in many important ways is relatively more of science. But understanding, for example, compared to character of the business, understanding character of management is much more of an art. Character of business is much more of a science and relatively less of an art. But understanding character of management is far more of an art and relatively less of science. Valuation is, in my opinion, much more of an art than science.
Really?
While a lot of time people think it is far more mathematical, but it is not. While, of course, there is mathematical numeracy involved, a lot of numbers are involved, and therefore it gives an impression of that mathematical part about investing. But really, valuation is much more about an opinion, a conjecture, but an intelligent conjecture, hopefully. And therefore, it is much more of an art. Why so? Because investing is mostly about future. Past and present may account for maybe no more than 5% or 10% of what is worthwhile in judging investment
Only
value.
10%.
Yes, less than that, I would say. 90% or 95% of what is worthwhile is about future. Future means uncertainty. Uncertainty means risk. And mitigating that uncertainty risk can only be with superior judgment and ability to blend your judgments as new facts, new insights, new ideas, new thoughts arise, to be able to meander your way and arrive at a new approach to judge or a new understanding of that business. Also, therefore, valuation is far more of an art, while most people tend to think it is mathematical. You see, intellect really is more of, I would say probably more of, so to say, science part of investing. But your discipline, your character, your wisdom, I would say is much more of an art part. And to that extent, invariably that art has a little upper edge in the final scheme of things. Intellect is not an assurance that you will not have ego. In fact, intellect can breed higher amount of ego than you need to have or you can sustain, or it is good for your wealth.
Very true.
But intellect can actually result into cultivating an artificial ego. Generating wealth itself can be a source of cultivating a newfound additional ego to burnish it and to kind of nurture it. Finally, dealing with markets requires a lot of art. It is not really much of science. Market psychology, markets are not designed to make you succeed. Markets have no vested interest in making you rich simply because you have put some capital to work in the market. You have a duty to earn returns. Markets have no obligation to give you returns. Therefore, you really make a market as one of the tools that you use in order to make returns, because time to time, markets will make good businesses look like bad ones by pushing down their prices, and time to time markets may jack up the prices for perfectly bad and inferior businesses, and therein lies trap. The generic market behavior in particular, say for post-COVID, in matter of less than 8 weeks, indices losing 40-50%, different indices, is really nothing but psychological. Your ability to be a bystander, yet being a player, combining these two very contrary ideas together is an art of investing. It has very, very little to do with science. Therefore, because as a player, you're playing the game, and your emotions as the game is unfolding are very much there. But it requires you to be a bystander coach kind of a mentality, that you are observing intensely but you are not playing, and therefore you have a lot of ideas coming to your mind how to improve the game even though you are not playing. Investing is a tricky field where both you are a player, but you need to have a mentality of a coach. And therefore, being that kind of conflicting strains of emotions simultaneously is really the art part of investing.
Is what they say, being on the dance floor and also being on the balcony, watching the dance.
That's
you need
right.
to do both.
Absolutely.
But Bharat, how do you marry that view with the increasing interest we are seeing today in algorithmic trading, right? I believe 50% of Indian market is now algorithmic, 60-70% of US markets based on algorithmic trading. That's all science, right? That's not art. So how do they get it right, or do they get it right?
Well, my personal view, I hope I'm right, but my personal view, for whatever it is worth, markets are not simple. They are easy. Investing is easy, but not simple. The emotion part is what mixes up with the rationality part and produces a very peculiar combination, a dancing nature of the market all the time. Mathematics, algorithms can capture what purely rationality and pure mathematical part of investing can be captured. But as I mentioned, investing is a lot of these other things mixed up, and which no algorithm can catch up. If this were not to be the case, LTCM, Long-Term Capital Management, very celebrated firm in 90s with, I believe, some 4 Nobel laureates as a part of the firm. After doing brilliantly for some 2.5 years with algorithms and lot of, there were 2 physics Nobel laureates there, one mathematics one, who all designed that algorithm and did phenomenally well for 2.5 years, as if there is no stopping. But then we all know how it went belly up and kaput in no time. Market is a very interesting mixture of both, of that what mathematical precise thing will sound, as well as a lot of irrationality and emotionality, and good part of emotionality is rational too, is all mixed up and producing a combination. Mathematics also gives an illusion of precision, an undue amount of precision than what really deserves the credit for, and therefore it deceives you into believing or self-fulfilling prophecy, which is implicit in that prediction, which is what algorithms are all about, and therefore it can give you a false hearing. Finally, I would say a lot of these algorithms are more relying on speed and engineering and design behind it to spot tiny inefficiencies, zoom down on them quickly, capture them, and because they are tiny advantages, in order to make them meaningful payoff, you put a huge amount of capital to work in order to convert that into an outcome. I think in finance, that approach is fundamentally dangerous, which can lead to, because a lot of bright minds can apply the same mathematics and same algorithm. When all of them mimic, you have no competitive advantage.
Correct.
But in irrationality of the market, your rationality is a huge competitive advantage. Your ability to have a view about future and to have an ability to keep refining that view with the new insights and aligning your investment ideas and thesis to that emergent reality as you understand without ego, but with intelligent adaptability is a huge advantage compared to that mathematics which it can never capture.
Of course.
By definition, algorithm will capture what is here and now, but not about future. And investing, as I mentioned, 90% or more of what is worthwhile is all about that future.
So, Bharat, you're not too worried then about AI coming in and replacing human traders?
No, exactly for the same reasons. I am not worried about it. There are a lot of things artificial intelligence can do, and a lot of it can do it with a celebrated capability and efficiency and speed. And there is a lot to commend about it. But like, Vinod Khosla said, a lot of technologies have made breakthroughs and have made world a very significantly altered place, but has not necessarily multiplied collective intellect of humanity. Technology is important and it has heralded progress. It has taken the world ahead. It has made humanity scale. It has made life simpler in many aspects, but it has made complicated also. Like we see with the Instagrams of the world and Facebooks of the world, that it does something well, but it creates other own social consequences. So artificial intelligence, for the same reasons, if the game of investing were to be pure mathematical, and even mathematics for that, for really at the highest level of mathematics, it is more philosophy and less precision. Much like a highest level of physics is much more deep meditative philosophy rather than very precise sounding conjectures.
Correct.
Therefore, when you really combine all of that, I would say AI may have a role to play to simplify some of the tasks that you conduct in investing, to be able to check some of the things that you do much faster, better, so that your own biases don't come in between. But other than that, whether it can occupy the mind of an investor, I still would find it hard. In the game of chess, it is not the same way. If you know, in the 90s, the Deep Blue.
Correct.
When initially Kasparov had beaten the Deep Blue very easily and very convincingly, but it kept raising the game because it learned and it kept learning. That makes artificial intelligence much more difficult to deal with because it's a self-learning mechanism.
Correct.
And therefore it has become harder and harder, and then now it has reached a point where it is impossible to beat the chess being played by the machine. But that's because chess is a game of complete rationality. It has no role of emotionality in it. Investing is fundamentally and will remain, because wealth, money, arouses passion, arouses emotions, arouses good and bad, everything along with it. And as I mentioned, intellect is not a substitute for rationality or a substitute for character or a substitute for discipline. The very fact that prices change, other things, nothing may change about the business, but your opinion of the value of the business changes. That has nothing to do with the science. It has all to do with the art. And therefore, I remain reasonably comfortable that artificial intelligence may come, may keep refining the game, but disciplined investors, conscientious investors have upper right.
Let's now talk, Bharat, about another principle of investing, which is diversification. Now, one of your icons, Warren Buffett, said that diversification is protection against ignorance and makes little sense if you know what you're doing. First of all, do you subscribe to this view? Is the principle of diversification overstated? Does it give low returns, for example? For an average investor, what balance should they strike between concentration and diversification?
No, I 100% agree with what Buffett has said. And even Munger would go to even greater concentration than Buffett. At the end of the day, despite well-known views of Mr. Buffett, his portfolio is still materially diversified in a very large number of businesses related, because his size is such where you would have meaningfully higher number of positions. But there is so much only humans can grasp, and there is only so much you can know about a business. And we all must recognize that there is only so much there that we can understand and keep continuing to hold in our head and keep refining and keep getting a better view on that. And therefore, by definition, number of choices you can make has to be limited, because you can't be good at understanding hundreds and thousands. You can be good at understanding probably fewer. Now that capacity of how many you can understand without creating ruptures may vary from individuals to individuals, and to that extent it may have different limit for the different individuals concerned. But fundamental principle that risk is reduced only by knowing what you are doing is unexceptional and very fine principle. Because risk is all about how much you know and how much you can bear the consequences of the risk that you are undertaking. Therefore, knowledge about what you are doing and what you believe in, not a false confidence, but a judicious confidence about what you know, and tempered by humility enough that you can only know so much, and constantly, therefore, you have to have an open mind to learn more. Not just in one field, but in diverse fields, not just about one business, but many. These honing of your skills and capability will allow you to have adequate but not too many businesses that you invest into. To give a mathematical number will be tough, because, as I said, capacities of the individuals can vary, but that extremity on that is easy to identify. If you say, I'll make investment only in 2 or 3, that's one extreme to take. And if you take another extreme that you will invest into 300 and 400, that's another extreme. Investing is not a zoo. That all kinds, it's not an animal menagerie where all kinds of animals, from rabbit to lion and from frog to tiger, everything has to have a place. Investing is not about equality. Investing is not a democracy that you give equal right to everything. Equity is about picking and choosing, and therefore, by definition, excluding lot of things and including only a few things. It is the art of excluding rather than science of including, which is very critical.
Interesting.
And therefore, extremities of too less or too much is very vividly clear. Within that, what is reasonable will be tempered by what may be capability of the individual involved. But in general, no matter how talented you are, there are only limited number of businesses about which you can claim to have adequate level of understanding, so that you are not imperiling portfolio by taking a risk that you should not be bargaining for. And therefore, judicious diversification, adequate concentration, both are same sides of the coin. And very important fundamental risk reduction principle. At times there is a temptation to play like God, that that you buy into just 2 or 3 and say that you know everything about it and that nothing can go wrong. There is no godlike attributes anybody can claim. Markets are too capable, too smart. Collective intellect of the market is beyond brightest intellect of the market, brightest capability of the market. Therefore, one should never assume that one knows so much that one can just afford to be like a prima donna and dismiss away any kind of risk as inconsequential. Therefore, buying into 2, 3, 4, 5 names only and saying, even Mangaru famously held only 5, 6 names. But one of the biggest ones was Berkshire Hathaway, which in turn represented large number of underlying businesses below that.
Correct.
So therefore, truly even his portfolio did not have just 4, 5, 6 names. You know.
But Bharat, if I come down from the pedestal of Charlie Munger or Warren Buffett or Bharat Shah, for an average investor, is he or she better off investing in index-linked funds, in ETFs, mutual funds, or should they really make the effort to invest in single-line stocks? What's your advice for the average investor?
Very important question. You see, I would say, and I'm not trying to earn a brownie point for investing fraternity, that it's a special breed, but investing is a special capability in many important ways. Less on intellect, but more on other aspects. And therefore, investing requires a good blend of many of these attributes: independent mind, temperament, discipline, character, reasonable graces, but more of wisdom.
And time.
And time, and passion.
Correct.
And deep belief about what you do, and suffering humiliation of the markets time to time, suffering knocks time to time, without losing self-belief and self-confidence. It requires amalgamation of many, many branches of knowledge, a lot of character assimilation within. Therefore, investing is not simple. It is easy, but not simple. And I would dare say, therefore, fundamentally, most people are not designed genetically and otherwise in many important ways to be automatically investors. It will, the intellect may be, maybe genetic largely. A lot of skills can be learned. Many of the character building attributes also to an observant and intelligent mind can be improved upon, not entirely, but to some extent recognition of your deficiency can be a source of improvement in the hands of a thinking mind.
Yeah.
So all these are possible, but I would say it's not easy to be an investor and make success, because a lot of issues are involved. A lot of emotional handling and maturity is involved. Therefore, even if somebody has money, has intellect, has time at hand, it still is not necessarily easy to be an investor. You can't be into investing because it entertains you, or it occupies your time meaningfully, or for some it can be huge adrenaline in terms of gambling instinct. It also is not entertainment. Therefore, investing is not a hobby, not an entertainment, not a time occupation device, not to unleash your urge to gamble. It's a serious accountability, responsibility, including for your own
Yourself,
money. I believe for your own money you are a trustee, and therefore you don't have unlimited rights on your own money.
Correct.
Therefore, people have to think hard before becoming investors themselves, whether they have that skills and amalgamation of attributes. If they make an objective and honest evaluation that they are not designed, then there are only two things to be done. Either you put it into a kind of an index, or you find people in whose capability and character you have faith and belief on a long-term basis. Both are, the second part is not easy. First part is simpler relatively. If you have a long-term view that in general this economy, this country, the society is going to do enough to create reasonable value, and therefore markets will reflect that proxy of the underlying growth and character and evolution of the society and economy of that country, then you have a reasonable idea of the kind of returns it will make. Like you can make a judgment that Indian markets reasonably can be forecast to be doing reasonable double-digit compounding going ahead. Sometimes higher, sometimes lower, but over meaningful long run, that can be expected as a fair outcome in the hands of many investors you put together. They still will all likely to agree with that. Therefore, if you have that view, and you can't make a discriminant view of finding whom to give and whom to trust and whom to believe in, then I think index investing makes sense. And because it's a relatively lower cost, relatively hassle-free, and relatively without your getting emotionally involved, it can do the job. It's a efficient servant to hire who, without creating too much of headache, will allow you to make that return. But if your ambition to earn a little higher than that, and a belief about distinguishing than the underlying average, then you have to pick and choose people. That does require effort. Finding manager is the same task as manager, investor finding good management. Because the same characteristics that you hunt in a good management of a business is what a prospective saver will need to find in a prospective manager to be entrusted money with. Never easy, but if you desire to earn 2%, 3%, 4% extra per annum over that index return, I think it is well worth the effort, because compounded over 20, 30, 40 years, it's a gigantic difference it makes.
Correct.
Therefore, it's well worth that exercise for them to do. Plus, at a conceptual level, index investing at a micro level will make sense. But at a macro level, where whole world becomes, say, index, then you are replicating the good, bad and ugly by your own, the very nature of the index constitution. Because index is all about replicating past. It is not about forecasting future. And investing is about future, largely. And therefore, index continues to carry the contradiction, inconsistencies, imperfections, what is there today in chugging along to go forward. You need enough counter to that so that capital allocation is in the right channel, so that societal value creation is enhanced at a macro level, are very important, worthy macro objective. From an individual micro objective, that may be efficient. Therefore, index becomes part of 25, 30, 35% of the overall market. Maybe all right, maybe tolerable, maybe right. But the moment it becomes bigger than that, then you are replicating monstrosities implicit in index investing also is a replicable character. That means deficiency of character, imperfections, mistakes of the index are without counterpoint getting replicated. Therein lies a big danger to the not just the markets but the value creation process, also to the societal character and economic evolution. Therefore, index beyond a point is actually counterproductive.
So how should average investor choose between index investing, let's say index funds, versus ETFs, which are typically passive, versus mutual funds, which are typically active, versus individual stock picking? How should I choose the spectrum?
Well, individual stock picking, as I mentioned, is very clear.
It's complicated.
You stand before mirror and decide whether, and objectively, whether you are up to it and good enough to do it or not. If you have figured out that you can and you should, then you should go that path.
Okay.
And then I think all other questions become irrelevant. You should locate capital entirely to what you believe will create value and persist that path on. But if you believe that that's not the strength or desire or your nature, then either it is index or ETF are just a variant. I don't see I don't see sufficient distinction between the two. It's just a way of putting the passive money to work. So real choice is between passive and active. And if you are generally a careful allocator, you may say, okay, given percentage of my capital, I'll put it to passive, let it earn what it earns, and I'm happy with that. And I don't want to be greedy to earn more. That's perfectly legitimate thing to do, to put maybe 20%, 25% of your capital to work into the passives. For the rest, you have to find actives if the aim is to earn higher return and get a judicious wealth optimization. Wealth optimization requires mindset, requires effort, requires long-term vision, requires discipline, requires willingness to tolerate some amount of mental challenges. And if you are up to it, then you must find for the remainder of that 75-80% of the money other than passives into finding people whom you think or believe, whether mutual fund managers, whether private managers or whoever, who can be entrusted with that money to do the job.
So how would you compare active mutual funds with PMS schemes, portfolio management schemes? How should one decide between those two?
It's a way of investing. I don't think, really speaking, it's a structure. There is nothing special about the structure. It is how each offering is managed is the skills and the talent and the panoply of attributes that a particular manager brings on the table, and what you think you feel comfortable with and you can relate to. Some investors themselves like to have excitement of, even if they trust money to the others, they want spice, they want momentum, they want this, they want that. Whether it is for their economic portfolio enhancement, whether it is good for it or not, but their excitement may surrender to the logic of it, and therefore people may find various ways of doing it. But I would say ultimately structures is not what is critical. It is the philosophy, skill and character behind that managing money, which is behind that structure, is what you have to look for.
Well said. Bharat, one asset class we did not talk about is private equity, which is gaining quite a bit of momentum globally. What is your outlook on private equity, whether it's in India or outside India?
I don't know enough about outside India to make very sweeping comments or very knowing comments about it. But of course, private equity is important. Venture capital also is important. Not that I can understand or not that I have capability to do it. Private equity I understand, but do I have capability to really manage money in a private equity format? I don't think so. Each is a separate beast and with its own peculiarities. But that said, I would say the record of public markets in India is superior to that of private equity. First of all, private equity record is not fully transparently available. Secondly, it is not externally affirmed and verified so that it has enough credibility of its own. The customers of private equity structure will know what they've earned or not earned, but there is not enough external validation of data as to how the industry, private equity industry in general, and a particular player has done. Because even data about a private equity manager per se is not always very clear-cut data. Apart from that, private equity also has a risk of less liquidity. And you see, less, so to say, transparency in some of the aspects. To that extent, in my opinion, public markets are more liquid, more rapidly adjusting to the reality as situations develop. Markets immediately adapt, and markets are forever fiercely forward-looking, ferocious machines, discounting machines, and therefore they churn all kind of data into an outcome instantaneously, virtually. That beauty and that elegance, at the same time fearsome speed and ruthlessness of market is something to behold. That private equity simply cannot capture.
Provide, yeah.
And therefore it doesn't have the same dynamism. And therefore you can remain into your own ideas, even if they are not as efficient as they may be, and may discover it too long after that they were not good enough. Finally, I would say that the private equity typically is a negotiation of a buyer with a seller. And buyer and seller both on private equity side are hopefully more rational. Therefore, seller of a business to a private equity, whether part or material part or whole, both sides have parameters, capability, and some method to arrive at what is a reasonable value of that transaction. And therefore, the imperfection of the public market and that emotionality of the public market, which allows you as a source of extra returns, is absent in the private equity market. Therefore, if you have a disciplined mind, then public markets offers you that little extra up your sleeve, because you're observing the dance which is going on, and you know when to quit it and when to join in. When the dance becomes rowdy and unruly, and when it is elegant and smoothly flowing, you can join, disengage, and benefit to yourself.
Bharat, my listeners will be upset if I don't ask you this question. What are your best investment tips for 2025?
Well, if you are talking of names,
No, at least sectors, or what should investor look at investing in India in this coming year?
no, as I said, I think in a graphic way, India is a harem of opportunities today, to my mind. In my 35 odd years of investing in Indian markets and observing the market closely, both as an observer, as a practitioner, in my opinion, India is probably at one of the best vantage points, even though indices have gone up a fair bit, attention of the world has improved to India, a lot of character attribution has happened to Indian market and opportunity. I still feel we are on a relatively virgin ground, and it is, therefore I wish I were 20, 30 years younger, because that will give me an opportunity to compound for in a most breathtaking phase for a longer duration.
True.
But I think, as I mentioned, one of the beauties of Indian reforms has been a very strategic character of the reforms. For example, in manufacturing, what we are doing, it is well chosen. It is addressing strategic needs of the country, strategic areas of vulnerability, so that we as a country don't become dependent. One of the first principles of warfare is to make yourself so strong so that war possibility doesn't arise, because your enemy is afraid of you to be able to get into a war with you. And to that extent, I think eliminating strategic vulnerabilities and limiting in various sectors, India is systematically embarking on those areas to ensure, for example, on energy, for example, on digital semiconductor chips and that entire value chain. For example, in areas like consumer products, durables, and consumer digital products like mobile phones and technology products. India is systematically identified and trying to substitute with the local opportunities. Secondly, it is they are creating entire value chain in the manufacturing, not doing some tidbits of silos. And the value chain is a far bigger value than the sum total of the components involved. Third, it is being built at a scale, not only for local but also international and at a scale. And therefore, I think strategic nature of the reforms being such where they are deep in multiple areas and they are synergistic, they have logical connect with each other. When more and more highways are built, more and more airports are built, more cement is needed, more cables are consumed. As they grow, more energy is needed, again which spurs the demand for cable. It requires distribution capability, logistics, a lot of manufacturing capability to feed your industry and to feed your drive. Greening of energy is an important agenda, therefore energy transition to be able to achieve. Therefore, as India is the fastest growing energy consumer at margin in the world, energy equipment, energy financing become very important large opportunities. As the wealth gathering is improving, wealth management services, financial services will have a lot of reasons to grow and not merely lending. Therefore, I think host of activities.
No, Bharat, you're dodging the question. You tell us what are your 3 favorite sectors that I should invest in. Just choose 3 sectors that you think, from your perspective, should be the best for this year.
I think manufacturing, I'll not limit to just 1 year, but I'll say
next few years.
3 to next few years.
Yes.
I think manufacturing and host of activities, capital goods, subsystems, assemblers, various things that go into it, I think is a very, very exciting opportunity.
Agreed.
Secondly, I would say pharmaceuticals, chemicals, they represent a very, very powerful long-term opportunity. May not have the highest growth rate, but very high quality, deep, rich growth for a long period of time. And very integrally linked to a society which from a improving physical prosperity will require many of these other benefits, your health, your education, and many other things, so-called social infrastructure. But pharmaceuticals, chemicals, India has genuine strength, a lot of capability, and I think I see that as a durable theme. Lot of things that the government is doing to make country self-sufficient in critical areas, defense, railways, electronic manufacturing, the outsource manufacturing services, your EMS, which is a large activity globally, and India is just beginning to get into that. I think that a whole host of opportunities is very large. The entire energy footprint is phenomenally exciting because it's a huge amount of activity. India is growing at a fastest rate in that area. Plus, it is very ambitiously embarking on changing the composition of energy. Even though it has relatively limited resources, India is advanced on their greening agenda way ahead of the other developed nations, so these 3, 4
Thank you for that.
among many.
Bharat, you said earlier to me that investing is almost philosophical to you. It's almost spiritual to you. Can you tell us a bit more about that? Where does investing and spirituality overlap?
I deeply believe investing is actually very spiritual. You see, one of the important things, and I talked about the yin and yang of life, and yin and yang of investing, that to be and not to be, to believe but also to doubt, to have confidence yet have judicious diffidence, to have trust but yet have skepticism, to be a coach as well as a player. All this requires very fine balancing of the many attributes in the life, in your internal personality. Secondly, one of the most important contributions that a spiritual and meditative mind brings to oneself is the calm, is the peace within, which eventually is a source of happiness. And if you are not a calm mind, if you are a reactive mind, no matter what you may do at a particular point of time and do brilliantly, but it can't assure you long-term investing success. It definitely guarantees failure on a long term. Therefore, long-term investment success cannot be delinked from that calm and reflective, meditative mind. Mind which is able to still the inside what is going on and combine it with the externality. How to subjugate external noise and to sublimate internal thoughts and arrive at a judicious blend, I would say is more a realm of spirituality and meditativeness. And without that, to achieve long-term sustained existence in investing is difficult. Also, I don't think investing really, to my mind, is about riches and about wealth. While of course, good investing will get both. It will make you rich beyond your imagination. It will make you wealthy beyond what you may need or you may have thought of. But the game is not about how much and the amount you have made or the wealth you have built. It is about the process that goes behind to make it happen. And it is not only to get it right, but do it right also, which is at a root. And I think that is, in essence, deeply reflective exercise, deeply spiritual exercise. It is not merely intellectual exercise. Not only to get it right, but to do it right too. Also, investing, whether you do for your own money or you do it for others, is a trusteeship responsibility.
Correct.
Even for your own money, you are a trustee.
Yep.
You don't have unbounded rights. In fact, you have more obligations than rights. And therefore, it is only mind which is able to digest that, subjugate one's ego, keep ahead one's responsibility, almost that Vedant kind of detachment that you do what you have to do, like a karma yogi for the world around. And in that, the good of your also is automatically included. I think that somewhere that connect is very real to my mind of all of that, because as a trustee of somebody, you acquire a different mind, different behavioral pattern. And I strongly believe that investing actually releases you from tyranny of doing things that you have to do just to eke out exigencies of life. It actually liberates you from the choices and makes you do what you love and passionate about. And happiness is all about what you love and passionate about. It is that which can make you work harder without feeling fatigued. Like I still work 15, 16 hours a day relentlessly.
Amazing.
But it's not fatigue, it's a joy. And so long as I enjoy it, I do it. And therefore, that's possible only when you view that exercise as very meditative, supportive, constantly cleansing your inner core. I think also one final thing I'll say. Investing requires you to assimilate inputs from so many branches of knowledge. It can be physics, it can be biology, it can be humanity, it could be psychology, it could be economics, it is finance, it is even human nature, literature which can highlight to you the human nature. So many and many more branches of knowledge intertwine in order to improvise incrementally, bit by bit, refining your own understanding. The latest work of all of that, and the cumulative build-up of all of that, I think is fundamentally, as an individual, it makes you better. I strongly
Amazing.
believe that.
This is the most holistic view of investing I've ever heard. Bharat, you should write a book on this. When can we expect a book? A magnum opus from Bharat Shah?
I wrote a book in 2013 in a particular mind frame, particular time limit, and particular thought process. And that book was a bit more on science and relatively bit of more on art. I am currently in the process of writing a book which is actually relatively more on art and relatively much less on science of investing. I might have already kind of written almost 600, 700, 800 pages.
Wow, can't wait to
of
read
that,
this.
Thing. But I still feel incomplete, and I feel maybe 2, 3, 4 more hundred pages. Maybe when I assimilate, I may condense and I may change this and change that. But it is in works, and hopefully not too far away. Certainly in 2025, the
So
book
this year we
be
should
out.
see the book out.
That's right.
Amazing. Bharat, that is such a good news that you ending this conversation with. Bharat Shah, thank you very much for your time today. Your analysis, your wisdom, your advice has been absolutely awesome, and I'm sure our listeners will benefit from nearly 40 years of your experience in the Indian markets. We look forward to that big book. We can't wait to read it. And as a keen traveler, I know you are. I wish you lots of happy travel around the world. Today has been amazing. It's a totally new look at investing, and thank you for those pearls of wisdom.
Very, very kind of you. It has been as much a joy for me talking to a friend, as well as a bright mind who has observed the world, has run a very successful career. Therefore, getting many of the pointed points from a friend as well as evolved citizen of the world, it has been as much a joy for me to talk to you.
Thank you very much, and look forward to seeing you in Dubai again very soon.
Thank you.
This podcast is proudly brought to you by MasterCard.
Money Majlis is sponsored by Weo Bank. Fuel your ambitions with banking designed to power your success. Discover more at weo.io.
Money Majlis is brought to you by Network International, the leading digital payments technology company in the Middle East and Africa.
Money Majlis is proudly supported by Now, the premier crypto as a service provider, now building in partnership with the top financial institutions in the Middle East. Discover more at aquanow.com.
That's it for this edition of Money Majlis. Please keep listening and keep sharing. Till next time, goodbye. Stay well and do good.